Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, audience and listeners. This is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing podcast. Today, I have Anton Mattli from Peak Multifamily, who is one of the leading multifamily financing agency. Anton is a CEO of Peak Multifamily Funding. He graduated from Zurich Business School. He's from Switzerland originally. Loves Switzerland for the view of it. And he has been advising family officers, high net worth individuals, and has done billions and billions of dollars of loans. Anton and I was discussing before this interview started, saying it's not fair for lenders to declare how many billions they have done, because that can be a lot of money, but the experience level, the knowledge and the acumen of the industry matters a lot in when you're doing financing. Hey, Anton, welcome to the show.
Yeah. Hi, James. Thanks for having me.
Absolutely. Actually, we are having, originally, I planned to have a meeting with you to talk about, what could happen similar to 2008 crisis, right? Because we have been talking about it for past few months, but now we are in the middle of coronavirus recession, I would say. And I think this is the first or second week that's happening. So basically, we don't have to predict what the recession can be, but we can predict, what are the outcomes from, this event, I would say, right? Could be, right? So I think a few months ago, you and I have a lot of discussion about, how the market would turn, how dangerous is the market right now in terms of, operators or a lot of sponsors or syndicators buying deals is over leveraged, overpriced, and all that. So, what were your thoughts before this COVID-19 recession came about, and how was your state of mind in terms of how the economy was and how everyone was buying deals? And we'll go into the details on COVID-19 and what's happening now.
Sure. As you're right, on the operator side, have seen quite a number of deals that for me personally didn't make sense. Right? Even though a deal was financeable from a lender perspective, from a debt service coverage, particularly when it's an agency loan, does not necessarily mean that it's a good deal from an equity investor perspective. So even though we were able to finance some of these deals, with a number of them, I would not have felt comfortable to invest in those deals. There were plenty of deals that still made a lot of sense, right? So don't get me wrong, it's not all of them, but there was only the number of deals that, in my view, didn't make sense over the last 2 years only have increased dramatically compared to before. And at the same time, we have also arranged bridge loans. And as you probably know, bridge lenders were extremely active. They have taken a major activity uptake over the last few years. So there was a lot of competition in the bridge lending space, which meant that you were easily able to get 80% of cost for your C-class property, and sometimes in pretty tough locations. And bridge loans make perfectly sense when it's a true value-add deal, right? But when it's not really a value add, and it's mostly to do a soft rehab, but you feel that you don't get the agency loan where you need it, and you go with a bridge loan, then I think it was much more problematic, right? So with that, obviously, we have seen quite a number of these bridge loans and deals that I believe, particularly in the current environment, will likely struggle. Because these bridge lenders, they are not like the agencies and FHA, right? That came down now with the forbearance offer. Don't expect that from bridge lenders.
Yeah,
right?
I know, it's crazy, right? Now I feel so happy. I'm all in Fannie and Freddie like loan. For the past 1.5 years, I've moved everything to Fannie and Freddie. So are you saying on the bridge side, there is no forbearance? Or what's happening on the bridge side with the COVID-19 crisis right now?
Well, as a general rule, bridge lenders have never been, some of them, the good bridge lenders, they have always been willing to make adjustments when they see that a borrower is behind of the original plan. The ones that are really in there as a partner, they have been willing to cooperate. And I think those lenders, and there are not really that many among all the bridge lenders that are out there, they will continue in during these times to help a borrower to get through that time. But the majority of bridge lenders are not, right? Because they very often it's not their own money, right? So they essentially have orders behind that they went to, and they have kind of an obligation to fulfill that loan agreement to the letter, and their investors demand that they fulfill their obligation as per the loan agreement. So some of them are very aggressive just by nature, and the others have the force from the investors they have the loan funded from to actually go into enforcement, or you can call it loss mitigation, as the nice term sounds, with these loans very forcefully and very quickly, right? So now maybe there is a little bit of a positive light here, that they may say, look, yes, we could foreclose right now, but maybe it's not a good time to do the foreclosure now anyhow. So let's just go through another couple of months and then see whether we want to foreclose. But it's still, in my view, they just kicked the can down the road for a very brief period of time until they go all the way in with their loss mitigation process.
But I think, it all depends on what's happening in April, right? We have another 10 more days to go, and we're going to see the rent collection. Yeah. But in general, I'm already seeing, even in my properties, there are residents who are declaring that they can't pay, right? And this $3,000 per family units, I'm not sure, as you mentioned, they're going to use it for rent, or is that one time? I'm not sure for how many months is that. But the thing is, the delinquency will be higher. So, I believe the sponsors or syndicators who are halfway through value add, and right now they are not done with the value add, so their rent might be struggling, right? If it goes below a certain level, they're going to be stuck right now because it's going to be negative. And as you mentioned, bridge lenders are private people, right? They have the obligation to whoever gave them the money. And
that's right. Yeah. So if you have already a property that is, let's say, a third empty because you planned all your rehab, right? Mm-hmm. Even if you do rehab, who are the tenants that you now can attract, right? Mm-hmm. And so you would have to attract them with very aggressive terms if you find them, and then you're still not at that level that you need to be based on your pro forma, which the lender wants to essentially base their decision on to release more rehab money for future draws, right? So then essentially that rehab money sits with the bridge lender. You have not performed as per the loan agreement. So if you want to go ahead further, you need to inject more equity, right?
Yeah,
so
it's basically
kind of a vicious cycle.
Right? Yeah, it's a downward spiral, right? Because now I believe on the bridge side, a lot of loan are based on LTV, right? Loan to value, and they're going to assume the value is going to drop because now your rent is going to drop, right? They're going to ask.
Yeah, it's a combination of loan to value, but as you go through the draw process, it's more driven by a certain amount of collections that you need to achieve and or NOI, and then the debt yields that you need to achieve with that, right? Yeah. So it's a little bit of a different measuring sticks, but at the end of the day, it doesn't really matter what you use. It's very hard to achieve these points that you need to meet at a certain point in the timeline when your property is not performing, right? And the reality is all these bridge loans, they all typically have very aggressive timelines to start with. So if you fall behind just by a couple of months, it can become very problematic when it says after 6 months we should achieve this, and you are essentially behind by 2 or 3 months, and it continues to to going in the same direction as you fall behind that once you're at year one and so on. Right? So I would say the ones that have enough cash on their own that they can inject as needed, they will be fine, right? So the ones that suffer the most are the sponsors that just kind of get by with their own personal financials, and they don't have the ability to inject a couple of 100,000 as needed to get the ball rolling at that property.
Yeah, but it's tricky, right? Right now, I mean, most sponsors can use this COVID-19 and burn the equity and get out, right? Or they can keep on injecting and try to, because no one knows what's going to happen in the next 6 months, right? So it's a gamble. A lot of sponsors or syndicators need to take, whoever on the bridge loan, if they need to continue injecting more money or give it back to the bridge lender, I guess. Right?
Yeah.
I mean, right now they have a valid reason. They can say the whole world is collapsing. I'm getting out now, right?
Yeah, if you're a syndicator, right? So you essentially can ask your investors, look, we are in really deep trouble. Do we want to inject more money? Mm-hmm. Generally, I would say what typically should happen is that you do a capital call. Mm-hmm. And if no one wants to do it, then you would have to lend yourself, or you contribute the equity yourself. But in most instances, it's not equity, but it's more a loan by the partners. But again, that all requires that the general partners actually have the cash available to lend to the property, and a lot of them I've seen out there that don't have the capacity, right? Mm. So it will be very interesting. Obviously, that always assumes that things really get bad, right? We don't know yet, right? Maybe it's a miracle and all that stimulus money somehow entices these tenants to pay the rent. Obviously, I hope for you and for everyone else who operates properties that's going to happen. But when based on history, I don't think that is really going to happen. And I think last night you had Brian on, right? And he was referring to the situation during the hurricanes and Harvey in Houston. And that's a perfect example, I would say. Right? We cannot compare it with 2008, right? I think we all agree with that. But certainly what happened with Harvey and the flooding is probably a much better comparison, right? Because everything had to be shut down. It was very localized, but it had to be shut down. And as Brian was correctly mentioning, right, the properties across the board suffered with delinquencies, right? So I would say we'll likely see that. We just do not know yet how big the percentage is by asset class and by location, right? I think it will depend a lot on locations. Obviously, places like the Northeast, the greater New York City areas only suffer more. Same thing in Washington State. In Texas, we have to see, right, how bad it is. Obviously, we have also the additional element of oil and gas that has played a massive negative role here for us in Texas, particularly for the property owners in Houston, and we don't even have to talk about Midland and Odessa, right? But even in Houston, it's only something that will, in addition to COVID-19, will have a negative impact on these properties. So it will be very fascinating to see how the performance looks like over the next few months.
Yeah, but I'll get a good indication in the next 10 days. But we already getting our property managers to start probing with tenants and who's having trouble and all that. So we are compiling that, trying to understand and trying to work with them some kind of payment plans. That's what Texas Apartment Association, or we call it TAA, give us guidance, right? But I think a lot of it depends on which submarket you are in. I mean, I know sometimes we put depends on, right? And then people think, okay, my property is good, right? But there's a lot more details to it, right? So like whether you have a base manufacturing in that area or not, or whether your city or wherever you invest is a lot of it service industry or not, because service industry is dead right now. Las Vegas used to be the best place to invest before 2 weeks ago. But I'm sure now the whole Las Vegas is closed down, right? I'm sure, people don't have money there, right? Because they are more on the leisure business, gambling.
That's right, yeah.
So hotel business. So basically there's no money. So within 2 weeks, things change now. So compared to places where, there's a lot of manufacturing happening, there's diversity of employment, you can still reduce the rent slightly, and then you still get people who can pay because they're still being employed, right? And
that's right. And if you're right next to an Amazon logistics center, you're probably good.
Correct. That's absolutely. And I'm still getting rents right now. Up to now, for the past 2-3 days, I'm still getting rents for April. So that's a good sign. But ours is all automatic, right? It's all virtual, right? So probably they already set up the ACH is all coming online. But we'll know about it in the next 5 to 10 days, right? It's very interesting times to see.
Definitely,
But as I said, last time, everybody was doing very well because the market was doing very well. Right now, sub-market location become very important, right? And the good thing is, whoever has this agency loan, I think they have many ways to weather this, either take the forbearance or just ride it through because your loan is there. But guys with short-term loan, this is very, very tricky right now, right? And you talked about the bridge loans and all that. Do you see the same issue with loans on credit union, the banks, small banks and all that? Do you think they still have issues similar to bridge loan guys?
No. What we have seen was actually so far has been very positive, where particularly these smaller credit unions and banks have been very cooperative in finding solutions, whether it's forbearance. And that's seen before it started, right? It's almost like, okay, we understand we are reaching now a tough period of time, and that you're willing to either modify the loan, to stretch it out, to lower the rate. So they are very, at least a good number of them, what we have heard back from various borrowers have had a very good experience there. Right?
Got it. So are they being managed by FA as well, the small banks and credit unions?
No, they are. It's all balance sheet based.
Oh, it's all balance sheet based. Okay.
So these are really the easy ones, the ones that originate the loans and then securitize them too.
Okay.
They are in the same boat as, I would say, all the other loans that are out there. I'm talking the ones that typically it's more the smaller loans, somewhere in the 300,000 to maybe 2 million, 3 million range, right? So not really the larger loans. There are some exceptions there, but they are loans that are not a significant burden on their balance sheet. And it's much better for them to work out these existing loans that they have on the balance sheet that, on the basis are still very sound. They're just going through a harder time that you're willing to work it out with the borrowers, right? So that's really for the ones that are on balance sheets, and the ones that really have had success. The borrowers are the ones that have already very good established relationships with these banks, right? They know the owners or the branch manager. And again, that brings us back to that relationship now is more important than ever, right?
Correct.
Whether you do a new loan now or whether you already have an existing loan, the way you have managed your relationships, whether it's your tenants, whether it's your property management company, whether it's your lender, now that all comes back to you, right? If you treated them badly, they will remember. If you treated them well, they are more willing to work with you.
Yeah. And just for the audience, if you guys have read my book, Passive Investing in Commercial Real Estate, I did very, very specifically mention that bridge loans may not be the best loan during the market peak, right? I'm not sure how many people read my book, but I did mention it there, right? And that was written like 2 years ago. And as I say, I stopped doing it just for my peace of mind. And I want to make sure that I protect my investors' money as much as possible, right? Rather than, doing these flips at the end of the cycle and giving them, taking large risk and trying to do a flip at the end. I rather go, on a much better, safer bet with a better, finance strategy, right? So,
right, yeah.
When was this triggered to you? I mean, I know we are talking about I think we are 2 weeks into this crisis right now, right?
Mm-hmm.
But this happened so quickly, right? When did you feel like, okay, we are in trouble right now? Because you and I spoke, and we had 12 different reasons why the market can go bad, right? We have Brexit. I don't know. We have 12 things. I can't remember what the exact things. We had so many things. We laid out what could go wrong, but I believe this is completely out of the norm, right? A medical health issue, a virus infection that's causing everybody to stay at home, right? I mean, is that right? And when did you start to think that, oh my God, this could be the next recession?
Yeah, I mean, we have seen already pressure in the system for a while, where we have seen that liquidity was an issue in the banking system. We have seen it already last fall, and we have seen it in January and February, just because of the overall view that we have reached a point where everyone is getting more concerned. But it was still possible with the Fed essentially doing all these liquidity measures in the past, as soon as there was the slightest view that there might be a little bit of a slowdown. So they were able to essentially put as much liquidity into the market as they needed to. Now, I would say the current situation and where we are now on the lending side really has started just about 2 weeks ago, right? So it's not that it really built up. Obviously, everyone was watching what was happening in China and then in slowly in Europe. And as it was building up in Europe, suddenly the clouds came out. But you may recall at that point, the treasuries dropped significantly, right? The Fed already dropped the rates once, and that actually resulted in some of the best time to borrow and to refinance. So that we had maybe a period of 2 weeks, maybe 3 weeks, but I think it was just around 2 weeks when we were able to get essentially 10-year and 12-year loans at close to 3%. Right? I know someone that was not arranged through us, but I know someone who got a rate that was below 3%. I think it was 2.94 or something like that. And that lasted really just for a brief period of time until 2 weeks ago, when everyone realized we have a problem, and that problem really just was shown again in the market that there was no liquidity, right? And the Fed was then coming out with their $1.5 trillion injection, where they said we are going to buy as much treasuries as we need, and we are going to buy commercial papers. And that still didn't do anything to the market, right? And then so the spreads actually started to tighten on the agency loans at that point, and then we were up into the mid to 3% in all-in rates. And then this weekend, then they announced, as you may recall, last weekend, the Fed announced that they are now buying also agency MBS for as much as it is needed, right? So, obviously, the hope was there that they would provide the confidence to the market that there is so much liquidity that they are willing to put into the market that no investor in these MBS should be concerned, and that would stabilize at least the multifamily market, right? Obviously, they have not said that they would buy other commercial mortgage-backed securities like hospitality or retail-based MBS, but it still did not help when it came to the agency side. And I would say that was probably the biggest surprise. So then they announced it on Sunday, and then on Monday, the agency spreads actually went up by 75 to 100 basis points. Right? So even though they announced it, that they will buy as many agency mortgage-backed securities as the market needs to get the liquidity in, the market obviously didn't believe it, and the spreads moved up even further. And we are still in the same situation today, right? So if you wanted to get into a new agency loan today with a new Fannie loan, 10-year Fannie loan, your rate will be at 4.5% for a larger Fannie loan that has some form of, as we call it, the mission-based, right, with affordability elements to it. If there was no affordability element to it, you're probably closer to 5%, right? So, and that's coming up from just 3 weeks ago when we were at the low threes, right? And that's all driven because the markets, there are no buyers out there, right? So no one is able to price right now. Obviously, we hope that will all be sorted out. And I think as market participants see how the impact on multifamily is going to be in April and May, it will calm down because then they understand how big that impact is and are able to determine where the pricing should be. But until then, it's essentially there is no one that is buying, right? And that puts Fannie also in a Fannie and Freddie in a very difficult position because they are obligated to buy that loan from a lender that originates that loan, and then they need to securitize it and sell it, and they do not want to keep it on their book, right? So they and even if they keep it on their book, they still have the credit risk transfer buyers that they are going to. Right, so their Fannie's goal has always been that they will find, and Freddie too, that they find other risk participants, and in order to find them, the loans need to be priced so that these risk participants are willing to buy whatever share of risk that they are participating in. And right now, no one is willing to take that risk. Right?
I know, it's crazy. So do you think we should? So whoever looking at to do deals or to refinance should wait a few more weeks or because I don't know, a few more weeks or months or what do you?
Yes, I think for refi is, in my view, is easier, right? Because you are not really under immediate pressure unless you're really in a very difficult financial situation. But then it's probably the last thing to consider refinancing now. Mm-hmm. I would wait on the refinancing side until the market has calmed down. Why would you want to now deal with an interest rate that is 4.5% to 5% when the 10-year Treasury hovers under 1%? Right, where if the market calms down, there is a reasonable expectation that it's the spread narrows again, and that you're back down, maybe not to the 3.5%, but maybe in 4% or 4.25%. It is such an uncertain time that, in my view, it just doesn't make sense to jump in and apply for refinancing. Also, the other point is since your future collections are still taken into consideration. If you apply today, a lender may underwrite to your T12 up to March and everything looks great. And as April and May and June come in, and if the drop is pretty significant, that will impact your loan proceeds at that point too. So not only have you applied for a loan, potentially have a very high rate, but now the loan proceeds are getting cut too. Right. So there is so much uncertainty that, in my view, it just doesn't make sense right at this point, unless it's an absolute emergency to do so. Right? Okay. When it comes to acquisitions, it needs to be a blazing deal, in my view, to even consider an acquisition, because you have the same situation. How do you negotiate with a seller? Right? What clauses can you put into a contract in terms of occupancy and in terms of collections that a seller would feel comfortable with but you are also comfortable with, because that's really what you should do, in my view. If you go under a new contract, you should say that occupancy needs to be at a certain level and the collections need to be at a certain level. And if not, then it's going to be through a retrade, right? So if you don't have that, then I think the risk is just too high. And on the other side with the loan, it's essentially the same thing, right? So yes, you can apply for that loan, but unless you have these clauses in that PSA, you run the risk that you go in for a higher price. You should retrade the seller, but you cannot, but the loan amount is still being cut, right? So my recommendation is, if you find that deal, the first step is really to get these clauses with the seller in the PSA. And if you have these clauses the way out, then you need to decide whether it's worthwhile to spend, let's say, $20,000 in loan application fees and all that you may lose. But that's ultimately a decision that depends on whether you feel that deal is so good. So I wouldn't say don't do it, but have these clauses in that PSA that allows you to retrade with the seller, that essentially then reflects the lower loan proceeds that you would likely get if occupancy and collections drop.
Got it. Yeah, and also I think it's a very tricky situation even to raise money, right? But I'm sure if you find a deal which is, screaming, good, right? And if you're an experienced operator, you probably can raise the money. But it's just so uncertain right now, right? And I don't know whether you probably already know this. I heard Fannie Mae right now is asking everyone to put like 12 months principal and taxes and insurance into escrow, I guess, right? That payment.
Yes, up to 18 months. It depends on the tier, right? If you're in tier 2, it's up to 18 months. Right? Okay. It's massive, right? So it's at least they say it's capped at 10% of the loan amount.
That's a lot.
It's a massive amount, right? So obviously, what does that mean? Now you need to raise more money, right?
I know.
So you've likely also, I would say, they haven't really lowered their the LTV or increase the debt service coverage requirements. That may come too, right? But I would say it's more on a deal-by-deal basis anyhow now. But let's assume that are still in place, that you still can get these maximum leverage and the same debt service coverage. Just the fact that you have all these escrow that you need to build is on top of the higher interest rate really hurts the deal, which means that you need to get a lower price from the seller. There's just no way around.
Yeah. I think Fannie is just saying we actually out of the market, but if you can meet this, we maybe come back, right? Which is basically bringing their.
Yeah, that's really right. Yes. Right, so actually, that's obviously on the conventional Freddie side and Fannie. On the Freddie SBL side, there has nothing been communicated officially, but there's only some rumors that Freddie may stop any new origination for a certain period of time, just to see where things all settle, right? So it will be, again, the next few weeks will be extremely fascinating to watch. How all the market participants, from tenants to operators to lenders, respond, right? And right now we just do not know, but it's only extremely difficult even to get an agency loan into place that makes sense. But I also would say it's really dangerous if someone, and that we still see quotes from brokers and lenders that come in at the 3.5%, because I guess they haven't read the news, or just to get the borrowers into the door, knowing that it will be retraded. So that is another thing that borrowers really need to be acutely aware of. Do not trust any quote until you have it validated as the broker, as the lender, multiple times. Is that still valid, right? And again, what we said just a couple of days ago is already outdated, right? So it's important to be really on top of it and know what the current situation looks like.
Got it.
Yeah. So maybe just to go quickly back to the forbearance discussion. Obviously, it's a very attractive program. It's good news when you have agency loans, but I still would caution to use that forbearance and just do it because you can, right? Both Fannie and Freddie, obviously they have implemented it. It came down from FHA, right? So it was not really Fannie and Freddie that wanted to do it, but it's essentially a government driven decision that it's necessary, and I think it's the right thing to do, and it's a very good backstop for all the operators. However, if you operate a property in a good fashion, particularly if you have owned the property already for a year or 2 years, you should have enough operating reserves to get through a month or two without having to already to suffer so much with, let's say, a 20% or even 30% collection loss that you immediately need to go back to the lender and ask for forbearance, right? So now, could you do it? I would say you probably could, but generally speaking, I would say you really should only go back when you see that you are getting close to the 1.0, 1.05 of debt service cover, and essentially make a case, look, it's so bad at my property, I have a collection drop of 40% or whatever it is, I need your help, right? But if, let's say, the drop is 10% or even 15%, even 20%, and you go right now to Fannie and Freddie, they may agree to it, but I think it will be a negative mark with them down the road when you go for a new loan, that they feel that you really haven't attempted to work out the solution on your own first before you went to them. Right.
Got it.
So I would just be a little bit careful there in how quickly you want to pull that trigger. Right.
Yeah. And also, forbearance is not free, right? You have to make sure you don't evict the person for 90 days or whatever time that you're getting that forbearance, right? So it's
that's actually an interesting part, right? So with Fannie, it's actually not just the 90 days. If you have that forbearance, right? So you're allowed, essentially, you have that 90 days, and then you can pay it back over a stretch of 12 months without any late fees and interest charge on it. Now, Fannie has communicated that you are not allowed to evict during the 90 days of forbearance, which is obvious, but also that you're not allowed to evict until you bring the loan current, which includes that 12 month of repayment period, if you choose to stretch it out for the 12 month. Mm-hmm. Now, Freddie so far only referred to the 90 days. I suspect that they just forgot to mention that, by the way, you need to bring it current, right? So I have seen it on Facebook and in some other places where people say, well, Freddie is easier because you only need to have you only have 90 days where the eviction is halted and then you can do it again. I suspect Freddie will probably also come out and announce that you need to bring the loan current and only then are you allowed to run your evictions again. So in other words, if you want to, or if you need to go back to normal and that your property allows to do eviction, your property manager, you essentially need to repay after these 90 days, right? And if you do not, and you want to stretch out for another 3 months or all the way up to 12 months, you essentially have potentially 15 months at your property where you cannot do any evictions at all, right?
How do they track whether we're doing evictions or not?
I don't know how they...
So there's no way to...
Well, obviously they can... I'm pretty sure that they all have access to the local court system and validate that you have not filed any evictions, right?
Got it. Yeah, but somehow it may trigger bad boy cover if you go and not follow the The agreement
that's a
that
good question, right?
Now they say you violated our agreement, right? So
yeah, so maybe it's not triggering the bad boy carve out, but don't go back to Fannie or Freddie if you didn't follow these rules to the dot.
Okay, got it.
Yeah.
Are you already seeing that sponsors and syndicators are getting letters from bridge lenders for people on bridge? I mean, or it's still very early right now to see what's happening?
We haven't seen anything. What we have seen is that a number of bridge lenders walked away from their loans at the last moment. Right?
Mm-hmm.
I mean, there were several bridge loans that we know of. Lucky for us, it was none that we were arranging. But I know of a number of sponsors that had bridge loan commitments in place that were supposed to close within a week to 2 weeks, and the bridge lender said, "Sorry, we cannot fund." Right. So these are situations that have happened already. So it's more that lenders essentially have pulled out. But we haven't heard anything yet on existing loans that are in place, right? And It's really too early, right? We need to see how April comes in and what I would say probably takes until May until things get really bad if a property has a massive loss of collections.
So where do you think, based on your experience, because you have gone through 2008 and you have been in the industry for a very long time, right? Let's say right now COVID-19 is gone within 1 month, right? So everybody start going to work, right? So what is the impact will be as we move forward to the financial market? Because there's a big shock happened in the financial market, right? There's a lot of people who have didn't have income for 1 or 2 months, right? What is there a downward spiral, or are we are good back again? The sun shines and everything go back to normal. Where do you see and what could happen?
I wish I had the crystal ball, right? But I think the harder we land over the next few months, I think the quicker the upturn is going to be. But I still feel that it probably will take 18 months to 2 years until we are truly stabilized, right? I know some feel that everything will jump back up again right afterwards. I think the damage to consumer confidence will still be lingering around for quite some time. Yes, there is that pent-up demand for certain items, but businesses still suffer, right? Particularly the small businesses, some of them really are suffering tremendously, and some of them are not able to come back. And also, I think a lot of the service employees, restaurants will be very slow in hiring. Now there is also a reason why to keep wages lower, right? So it's the impact, I think, on the GDP overall. We probably go through, obviously we will jump up very quickly again from a deep drop. But this year, it's definitely will be negative in my view. Right? Goldman Sachs talks about roughly 3.8% for the year after a 25% drop. I think Morgan Stanley talks about 30% drop. Who knows? Right? But I think when you look back in 2008, also when you look back into the savings and loan crisis, I haven't been around for the actual savings and loan crisis in the business, but I was when I first started out in New York in banking. I was involved with a lot of the workouts of loans that went through in the early 90s that were caused during the savings and loan crisis in the 80s. So it still took several years to get out of that. And as we have seen in 2008, it took a long time to get back humming. And yes, it was a very different situation then. But here, the shock, in my view, is so much vaster, and we have also it's at the global level, right? the global economy is suffering so much, and a lot of the U.S. companies are dependent on global trade too. So everything just will take much longer to recover. Right? That's my personal view. And again, I think it probably will take 2 years, 18 months to 2 years just to fully stabilize.
Got it. So yeah, I mean, so there's a lot of discussion about, hey, this is going to be a sharp V, right? So we go down very quickly, we're going to come back and everything is normal, right? That's what even the government is saying, right? The economy is going to be roaring back again and everybody go back, it's normal again, right? But what you're saying is, in terms of recovery, a lot of businesses, global trade, yes, impacted, maybe the hiring would be slowed down because the profit has been lost, I guess, right? They want to be careful, I guess. But for example, let's say a restaurant has been closed down for 2 months, right? So the third month they open again, they back to business again. Do you think that will be slower in terms of hiring as well? I mean, because they're back in business, right? I mean, they probably have 2 months rent that they didn't pay.
Yeah, so it will be very interesting to see how the human behavior is going to be at that point, right? So particularly the first 6 months to 9 months, right? So yes, even if all the governors and at federal level to say now we are clear, obviously the virus is still lingering, right? So I think people will still practice a little bit more of that social distancing. Everyone is a little bit more careful. Personally, I feel air travel will probably not pick up nearly as fast, right? Because everyone feels, why do I want to be in that airplane with other people next to me? I cannot really walk away. Also, I think large events probably will have a much harder time to come back. So it's really hard to tell, right? I just feel based on all the downturns we have gone through, very often people say, well, it comes back fast. And I think the initial recovery undoubtedly will be extremely strong, right? I think there is no doubt about that because we are essentially shut down to a large extent. So it has to come back drastically. But to really come back to the confidence level where we were before, I think it will take much longer.
So you're talking about the consumer confidence, right? So
yes, and business confidence.
Got it. Yeah, I mean, I read somewhere that consumer confidence is the most important indicator, right? For any economy or any crash or any recovery, right? If that comes up, everything comes up. If that goes down, everything goes down, right? Yeah. So no matter what you do, right? The consumers need to be confident in terms of probably spending money and doing events and doing taking flights. And so, for example, let's look at class A, B, and C renters base, right? I mean, class B and C is a lot of service industry. People are on paycheck to paycheck. I don't know. I'm just thinking this quickly, right? They may be okay. So now, third month, fourth month, we are back in business. I mean, unless their wage is lower, then it's an impact to them. But if their wage is same, they probably have that wage coming back to them again. Maybe they are scared. Maybe they want to go to a lower rent amount. Maybe, I do not know. But I think still the impact to the flights and to the big companies, I guess, right, it's going to be more because now this is a global trade. So could that be the A-class renters be more impacted compared to B and C in the long run? I'm not sure. I'm just thinking this quickly. It depends on how fast it come back and what is the wage they are getting and how confident they are. Right. So.
I think when you look at most people that live in A-class properties, they have pretty decent jobs, right? And obviously some of these jobs are now being lost, or at least they are in a furlough, so they are not getting paid right now, so they can collect their unemployment. And I would say if they cannot afford it in the A class, they may move down to the B class, right? So that's where I would see people that struggle in these jobs do not get back, that they need to move down into B. I just do not see that someone who is in an A class will be willing to go into C-class property, right? So I would say they would probably rather move somewhere else than into a C-class property. And I feel kind of the same for the people that live in B-class properties, that they will moving into a C-class property is for them, in my view, is also kind of the last resort. Now, the big question is how the residential market will evolve, right? Because we have not even talked about that, right? How will there be a massive drop in prices? Because in the short term, because no one now in some markets can even see properties, right?
Yeah. Are they getting forbearance as well, the single family houses?
I think when you're residential, I'm not active at all in the single family space, but my understanding is if it's your own primary residence, you get forbearance. You can apply for forbearance too, but not for an investment property, right?
Oh, got it.
But I think I'm more wondering how it would work for someone who is in a B-class property. Would they have an opportunity to potentially then buy a property, and if they are not able to buy a single family home, whether they would be able to rent a single family home instead, right? I just do not feel, and again, some people said that during the last downturn, a lot of people moved down from A to B and from B to C. Based on it's hard to track, right? I do not really believe anyone has been able to properly track that. But based at least on what I have seen during that time, there was not really much movement. There was a lot of movement from A to B because of that pricing point, but it's still a decent quality property when you are used to an A-class property. But I have not really seen much coming from a B-class to a C-class, right? But again, I'm not an expert in this, right? There may be economists out there that have studied this.
Got it, yeah.
But I just do not feel that these movements are really happening. Now, when it comes to the service employees, I agree with you, right? Once they start back up, they need the employees right away, right? Yeah. There is no doubt about that. And I think that's really, in my view, is kind of that positive light for C-class properties at the end of the tunnel. Once that shutdown is over and restaurants are able to operate again and stores are able to operate and all the other service type related business, including hotels, they have a job again.
Provided they don't have a negative wage growth, I guess, which could happen as well, right? Businesses may be covering this. But this is, within 2 months, if I'm if I'm a restaurant owner, I will hire back the same people, right? I have 2 options. Either I pay them the same amount before they leave, or I pay them slightly lower, I just don't hire. 3 options. I don't hire some people, right?
So there the question again is how many restaurants are able to reopen, right?
Okay.
So we just don't know if it's just for another month or 2 months. I would say the majority are able to cover the loss and go back to normal afterwards or go back to business. But a lot of them, I think, will, without some form of a bailout, wherever that comes from, will probably not be able to reopen. Right. So that's where that question comes in. Is there also a pressure, at least in the short term, on wages, that whoever is in the service business now does not have as much choices as they've had pre-COVID-19? Right.
Got it. Yeah. What about the construction loan? What's happening in that space? People with construction that is ongoing right now. From what I understand, the construction loan is also a loan where, if the value of the building that you're constructing drops, they may ask the whoever the developer is to put in more money right now. Could they be in trouble as well?
Yeah, we haven't really seen that yet. It probably depends on what phase you're in that construction loan, right? If you're in the early phase where you just started the earth movements or started with going vertical, and you're still a year out plus to start your lease up, I do not really see that impacts it that much. If you're already doing your lease up period, then I think you need to go back to your lender and find out how you can extend that loan, because usually you may have 2 to 3 years, like 2.5 to 3 years of the construction before you go into perm, and you may need another 6 months to complete that lease up. But if you're early or right during the construction, I would say it shouldn't be such a big issue, because once you do, when you consider the leverage for most of these loans is relatively low anyhow, right? Where you're at your 60, 65 of cost, maybe 60, 65 to value if it's a more an established sponsor. So the leverage is not really, in most instances, not that high to start with. So I don't think that these lenders will be holding back. I'm more concerned about, again, the hard money construction lenders that are out there too. Right?
Okay, so the hard money construction lenders. Okay.
Yes, so where you are in your 8, 9, 10% construction loans, these players I'm more concerned about.
So is there a chance for the construction loan guys to say, okay, I'm not funding anymore, because they go on draws, right, based on the progress of construction?
Yes.
Is there a chance they said, okay, we are done, we are no more touching, we are no more funding you, we are out, even though they have signed the commitment, because they probably don't have the money, it's all come from some pool of money, right? They are not
sure. Yeah. So I would say you have that risk, right? The larger the player, I would say the less likely it is, right? I would say if you have a strong bank, a bank will continue to lend. If you have a life insurance company that has provided it, they likely will continue to lend and have the access to the funds. But if it's a private lender, then I would be probably more concerned, right, that they are able to continue to fund the draws.
Yeah, that's interesting, because I think in 2008, that's what happened to a lot of construction projects, right? Everything stopped because everybody ran out of money, right? So.
Yeah, it could happen, right? We do not know, right? At least so far, we haven't seen it. Where they have come to a complete halt. And again, the private space I do not know, but certainly the institutional space hasn't come to a complete halt yet.
Got it. So the other thing that I want to just give some education to the listeners is how a loan can be made from non-recourse to recourse, right? And I know, since we talk offline, in the past crash, or you had that one of the function that you are familiar with, or you were doing is like lenders were trying to figure out how to make deals from non-recourse to recourse. What are the potential ways that can happen? I mean, we talk about this bad boy carve out in the agency loans, right? But
yes, yeah. So. Obviously, I think most of your listeners have heard now of the bad boy carve out, right? Which essentially means that if you cause fraud or gross negligence, then that loan can turn into a personal recourse, right? And one of the examples, fraud, is kind of obvious, right? When it comes to the property operations. When it comes to gross negligence, it can be that you are not maintaining the insurance, right? That can be, even if you forget about it, that's gross negligence, right? So even if it's unintentional, it's still gross negligence. If you do not verify that the insurance meets all the agency requirements, particularly when you may change the insurance, right, from one to the other, and somehow you feel, I get a better rate, and then suddenly you get that better premium, but you may not meet all the requirements of the loan insurance requirements. So these are kind of the obvious things, right? What is now a little bit, go ahead.
But usually the agency have this specialized insurance department to verify all insurance requirements met, right, whenever we change the insurance provider.
Yes, they should. Right, as it goes along, it's essentially the servicer is supposed to track this, right? But it's still up to you to verify that you actually meet these requirements, right? You cannot say, well, the servicer from that lender didn't say anything, so I'm fine. No, that's not the way it works, right? So, so it's really important that with an insurance change, obviously, if you get the approval from the insurance person at the lender or whoever they are hiring and gives the green light, and it's a different story. But that's not, as you're in a loan, that's not necessarily happening. I'm not talking about when you apply for the loan, but more down the road when you make changes to the insurance. Right?
Yeah. I mean, my experience has been like they are very, even I've made changes to my insurance, and the insurance department is so particular. They go into every line item, they make sure we're meeting it. So there could be some dust lenders which is not doing a detailed job, I guess.
Yes, so that's right. It really varies from lender to lender.
Got it.
How detailed they are. Now, what a lot of people do not realize, and that's something that we have discussed, James, right offline, is that your representation and your other guarantor representations when you apply for that loan are also part of that bad boy carve out. So what that means is that if you or any of your guarantors make a representation when you apply for that loan that then can be proven as inaccurate, and I'm not talking about I put in a value for a property that I felt was $1 million and it's only 900,000 or 800,000. I'm talking about gross misrepresentation of your financial strength, of your experience, but particularly your financial strength. That can be triggering that bad boy carve out, and we have seen that in the past. And you need to understand, right? Particularly when it comes to Fannie. What a lot of people do not know is that each Fannie lender has a loss share agreement with Fannie, so they take a loss. If Fannie takes a loss, they take a loss too, and they have that first loss arrangement. So they have an interest of loss mitigation, and obviously, if the property somehow will not pay back the loan plus all the accrued charges, they need to look for other solutions, right? And one of the items is that they will have in-house or external lawyers look at all the representations that were made pre-application, right, to approve that loan, or aside from all the documentation that was submitted throughout the loan being in place. So it's very important that you trust your partners, that they are not lying, right? And it's we have seen it a lot, right? A lot of people claim that they are accredited investors and they are participating in deals that are 506Bs, right? And because you don't need to verify that you are an accredited investor with these 506B offerings, but then when there is, they suddenly then pop up and do their own or attempt to do their own syndication, and then you suddenly realize, well, you're not really an accredited investor, right?
But that's not really a loan thing, right? That's more of a SEC guideline.
No, that's not a loan thing. I completely agree, right? But it's just an example of a lot of individuals, because they are so desperate to get into deals, particularly on the GP side, that sometimes they are stretching the truth, or into deals that you're sometimes stretching the truth of what their true situation is, right? And so it's it's really important to ensure that all the partners and guarantors that you have on board, that they are not grossly misrepresenting their situations, whether it's experience, financial strength, that everything on their REO schedule is really true. Why not that they, right? No one is really verifying this.
Oh yeah, no one looks at that in detail,
right? No one is looking at tax returns. So there is only a risk that someone can inflate their balance sheet and their experience tremendously without that being verified.
Got it. All right, Anton, why not you let our audience and listeners know how to get hold of you?
Yeah, sure. So my email address is amattli@peakmff.com. So that's amattli@peakmff.com. And that's probably the easiest to reach me. Also, when you're on Facebook or LinkedIn, just type in my name and then I will pop up. It's a pretty unusual name, so it should you should find me there. And I would say that's the easiest to reach me.
Awesome. Thanks for coming on the show. I think this is a really, really timely show in terms of discussing the loans and all that, right? So sometimes when nothing happens, when we talk about how risky bridge loans are, nobody really cares, right? No passive even look at what the sponsor is taking loan, right? They just look at the numbers and did that. But keep in mind, I did wrote in my book like 2 years ago, right? So if you have read it, I mean, there's a lot of resources out there as well. You would have been warned about it. There's nothing wrong. It's just market risk. If sometimes you make a lot of money doing bridge loans as well.
Sure, but, absolutely.
But it just depends on the market cycle and the sponsor and the syndicate, how strong they are as well. I mean, there's a lot of sponsor who's going to write this bridge lending, uncertainty as well, right? Fine, but just for anybody to be aware of, I guess. Thank you very much, Anton.
Yes. Yeah. Thank you, James.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.